So when you listen to the mainstream financial media and all the real estate bulls and the investors, they tell you that, hold on, just hang on to your real estate portfolio for a few months, only a few months, because the help is on its way. The rate cuts is coming this year, and when it happens, your real estate portfolio will go to the moon. Okay, that's the narrative that they are presenting in the mainstream financial media, as well as all those social media platforms where the realtors and the investors are kind of pitching this narrative to you that rate cuts coming, you cannot sustain with this level of debt with that high interest rate, so it must come down, and when it happens, your worries about negative cash flow will be over, right? Your valuation will go up and it will be all rainbows and sunshine. That's what they're telling you in the mainstream media. But let's talk about that in this video. So what is the probability for Bank of Canada or Federal Reserve to cut rates? Let's say it is 50-50, okay? Because things are changing rapidly. It may or may not happen, right? It all depends upon the economic conditions, the inflation expectations, the unemployment number, the fear of recession, the GDP. All of those fundamentals are playing in terms of deciding about rate cuts or keeping at that level. So things could change in the middle of this year as well. But let's assume that this is 50-50 chance, and let's assume that what CIBC is predicting, which is the first rate cut by June this year, if it happens, then what if it doesn't impact your mortgage rate? What if it doesn't impact your car loan interest rate? What if it doesn't impact your personal loan interest rate? That's a possibility, right? So let's consider that. Let's understand what is the interest rate set by Federal Reserve and Bank of Canada. In Canada, it's called overnight rate. In US, it is called Fed funds rate. So that is the rate that banks actually charge each other when they lend to each other. So it's called interbank lending rate. And also when the banks park their cash as part of the reserve requirement at the central bank pays the interest on those reserves. That's the rate that they set, and that's how it is applied. But what you pay on the street with regards to your mortgage rate, with regards to your credit card rate, and your any personal loan rate, that is different. And that is not set by Bank of Canada. It can influence that, but that is set by the market participants. Who are the market participants? These are the investors who are buying that debt in the bond market. So let me explain that. So what is bond market? Bond market is a debt market where the debt instruments, the debt securities are being sold. Okay, government bonds, provincial government bonds, corporate bonds, as well as the mortgage-backed securities. So when the bank issues you a mortgage, they have hundreds of other mortgages on their balance sheet. So what they do, they actually package them up and they sell it as a mortgage-backed security in that bond market. So that mortgage-backed security is purchased by the market participants. That could be a financial institution, could be a bank, could be a pension fund owner, it could be a hedge fund owner, it could be an insurance company, it could be a foreign entity, bank or government. All of these financial participants in the marketplace, they buy these debt for government bonds, corporate bonds, mortgage-backed securities, and other type of bonds as well. So when they purchase these bonds, they demand a specific interest rate that is set by the market based upon perceived risk, inflation, and growth expectations. Okay, so when we look at the Canadian 5-year bond yield, which is hovering around 3.7% right now, that means the investor class who are buying these government bonds from the bond market, they are demanding at minimum 3.7% yield on those 5-year bonds. Okay, and that is very much correlated with the mortgage-backed security bond yield as well. So when we see that the minimum yield at a government 5-year bond is 3.7%, that means the interest rate on the mortgages cannot be lower than that. Keep in mind that. Okay, so even if Bank of Canada start cutting rates and bring it down to, let's say, 3.5%, that doesn't mean that your mortgage rate will be cut down to 3.5%. Okay, that is set by the bond market. the investors who are buying the debt and the securities in the bond market. Okay, so let's assume that if the inflation is hovering around 3% and the future expectation from a GDP perspective is flat, which is not far from reality, then how come the investor class will accept anything lower than 3.5% today? They cannot, because they have to protect their own purchasing power, because they are lending their capital to the government or the banks. When buying these debt and securities, they need to make sure when those securities are matured, they get their capital and their profit back. Okay, so if the yield on the 5-year bond and 10-year bond is around 3.5% minimum, that's telling you that in the next 5 to 10 years, your mortgage rates cannot be lower than that. Second important point is government is running fiscal deficit like a drunken sailor. That trend is not slowing down, right? And if you look at this chart, it tells you that government will be continue running fiscal deficit, and when they do, they issue new treasury bills in the market. That is newly issued bonds, and that bond needs to be consumed in the bond market. So when government increase the supply of bonds in the market, typical demand supply rule, so if you increase the bond supply, it will drop the bond value, and bond value is inversely correlated with the bond yield. So if the bond value goes down, it will likely push the yields up. So in future, it is more likely the probability of pushing the yields up is much higher than staying at this level or coming down low. Okay, so there's so many things at the play, right? I'm just oversimplifying this whole scenario, but for you to understand that even Bank of Canada cuts rate, it doesn't mean that the rate you pay for your mortgage, for your car loans, for your personal loan is going to be reduced as well. That is depending upon the market participants, based upon the perceived risk, based upon the future inflation and growth expectation. Right now, they are not looking good. Growth is flat. Perhaps it's going to be negative growth for next year or so. Inflation is sticking around 3%, and the perceived risk is much higher. Why? If you look at what's happening with the regional banks in the US, because of commercial real estate fiasco, that risk is continuing to go up month over month. Okay, I'll make another video about that whole thing as well, how the perceived risk is going to stay higher because of the commercial real estate fiasco. That is not going to be fixed very soon. And the banking system is so much intertwined. If one region is affected, it spills over in other regions, just like what we saw 2008 and 2012 in Europe as well. I know this is a complex subject. I tried to oversimplify it, but if you have any questions, put them in the comment section. Ask me, correct me if I have stated anything wrong. I will be more than happy to learn from you as well. But if you like this video, give me a thumbs up and subscribe, and I'll see you in my next video.